Krishna, afternoon. Thank you so much for your time. So, one of the brokerages which you may be reading is calling for a strong pre-election rally. And this in the face of the fact that almost 2-3 months in a row, large caps have got very quiet in trade and mid cap and small cap part is rallying. Your fund also must be doing very well in the small cap because you launched it at the right time. What do you think of this, the prospects?
Clearly, economy doing good. So by default, markets are an outcome. We bound to get investors across the space as a country, as a market. So I think those issues are in place. If you look at relatively speaking, yes, for a change, one might end up saying that yes, large caps looks slightly more attractive right now. The way valuation catch up happens across large, mid, and small spaces over time. We've learned that markets do normalize, market do move in cycles. So I think large cap looks attractive for now. Small caps, exactly maybe 8-10 months back, they were quite attractively valued, and we saw what kind of rally we've seen in small cap. Yes, we did launch our fund almost at the right time in terms of December 20 to launch our own small cap fund. So yeah, small caps which are undervalued have now caught up. Maybe RBI pause was one of the trigger which drove it. For now, it looks flows are driving really much faster than what one possibly can think of from a pure fundamental catch up. So that's where I think large cap looks attractive, and need not worry, because not all small caps are bad. You're always bound to find good companies catching up with economic growth phase of their own, and coming to markets for a good value creation.
Biren, we've also seen a spate of big blocks which have come in, QIPs, blocks by founders, PE guys, and one section of the market worrying that this is probably a sign that the insti guys, the big guys, see the market right for selling, and the retail is actually buying in the form of mutual fund participating. Is that a sign of worry or not really?
I think there are two parts of it. One is, let's look at the broad principle of market economy, right? There's always going to be a demand and supply combination. So where there is a demand for companies, good companies to buy from, and there is a supply of existing investors who want to sell. In sometimes those investors actually happen to be promoter, but majority of the time those investors actually are institutional investors or individual investors in whichever shape and form. So won't really worry too much on it, as long as the name of the company in terms of the governance, business model, valuations are reasonably comfortable, acceptable. So pure supply of some shares by a promoter or a private equity investor is not worrisome. I think more worrisome really is what matters is perhaps the valuation, and that's where we need to think of it. And in a way, market matches demand supply. So if there is more demand for shares from investors, supply does come in, which is nice way of getting some sort of price discovery mechanism being right, because if there is high degree of ownership by promoters, in some cases you don't really have a right discovery of price. So I believe it's all good actually to let this happen. Yeah, the quality of company chosen, the valuation does matter to markets, and that's what from a institutional investor perspective, that's what we will be focused at in terms of buying perhaps the right set of businesses and valuation combination.
How's your small cap fund doing, Krishna?
Yeah, so Ajay, the way I said, we launched our small cap fund somewhere in end November, and we started investing from mid December. The fund is doing pretty good, I guess, in terms of its own a path for value creation, and the market has been pretty benign, favorable for small cap investors, especially in last 6 months, because RBI pause was a nice trigger. We've historically seen small caps do reasonably well when monetary policy is conducive, because let's not forget, majority small cap companies have a nice worry in terms of interest cost to sales ratio. So when RBI policy is on a conducive side or expected to move on a conducive side, these companies have a nice growth path over and above the normal business growth which comes from top line. Interest does help you at below EBITDA level. So yeah, I think small cap is it's done well for us, and we do expect a similar thing. Only thing one needs to worry about is valuations on a individual set of sectors or stocks, and that's where we believe broadly the valuations are normalized now. But yeah, do always find those pockets of growth for investors.
Krishna, how are you looking at the cycle right now, especially the intersection of the macro cycle which India is in right now, the business cycle we are in right now, and the market cycle we are in right now? So we look at an intersection of these. Where do we stand, and how should retail investors approach this issue?
Yeah, sure. Yeah, it's a nice combination. Macro overlay, which partly comes from geopolitics, in terms of how maybe oil price move, how China plus one strategy moves, how offshoring plans for the big importers in the world play out. So that's one piece. They're looking for something, some country which can step up to take the incremental 5, 10, 15% market share, which is pretty good for some countries like India. So that's a macro piece in place. Look at how the economic cycle is. Yeah, clearly we are growing. Maybe relative growth can always improve with some support from global customers. That's what our story actually is. Is exports is a story for India. We will be able to provide a lot of goods to the world, having done on the services side. So that's again the macro drop of economy. The only other nice part about markets really is that markets have a very nice interchange between sectors in terms of valuation multiples, and one very intriguing part which all of us as an investor have learned is that same 1 rupee of profit earned by different sectors has a different market implications from a wealth creation. There are some sectors inherently traded at a low valuations in terms of 10 15 p is something which we are used to pay, and that's most of it. And there are some sectors, some stocks where multiples go as 50, 70, 80 kind of multiples. So that's a nice interplay between economic growth, which plays out, and the market cycle, because market cycle gets that perspective of valuation multiples, which can create a lot of wealth, or perhaps can take away some part of wealth depending on which sectors do well. I think that intersection is pretty good for India broadly on every front. Uh, only caveat should be that one needs to respect valuations, because over time you learn that once you respect valuation, market ends up respecting your investment style and your portfolio outcomes.
You also are planning a business cycle fund. What will the philosophy of that be?
Yeah, so we actually in the midst of the business cycle fund, in the sense that today is what we're going to close the fund in the initial NFO period. The broad philosophy is like this. In a growth economy like India, every sector is going to take its own chance to have a higher profit growth cycle relative to each other. So let's look at it this way. Almost every sector earns its own share of profits, but when those profits are seen on an incremental basis, you see a nice split. You see a nice market share being gained by certain sectors on an incremental basis, and by default lost by somebody on an incremental basis. So as an illustration, when metal companies do well, metal producers end up making better share of profits on an incremental basis, while the metal consumers end up taking that hit, and to an extent profit pool keeps on shifting. A similar example happens to be on the interest rate cycle side. When interest rates rise in an economy, banks being the lender typically get far better share of incremental profit pool versus the borrowers. So our idea is simple. Economic cycle does play on the incremental market share of profits in the economy. On the market cycle side of it, which says that every rupee has a different valuation implications across sectors. So if one is able to evaluate how the profit growth participation is going to be going ahead, and evaluate vis-a-vis the market implications from a valuation multiple, you can actually have a portfolio construct which can keep on alternating across sectors, because India is growing, every sector is going to grow. All we looking to measure and monitor is the valuation multiple from a market side perspective.
All right, Krishna, we'll let you go on that one. Thanks so much for joining us on the show.
Thanks, Ajay.